Do you know what 90% of traders have in common? They're not making as much money as they could be, and it's not because they're not smart or they're not trying, it's because they're making a handful of common mistakes that are hurting their bottom line. Take John, for example. John is a smart guy. He's got a degree in finance and he's been trading for over a decade, but despite all his knowledge and experience, he's not seeing the returns he'd like. Why? Because he's falling into the same pitfalls as 90% of traders out there. John, like many traders, is letting his emotions get the better of him. He sees a stock start to drop and panic sets in, so he sells. And then he watches as the stock rebounds and he's left kicking himself for selling too soon. Or there's the case of Maria. She's been trading for a couple of years and she's doing pretty well, but she's not maximizing her profits. Why not? Because she's not diversifying her portfolio. Maria tends to stick to what she knows, investing heavily in the tech sector. But when that sector takes a hit, so does her portfolio. And then there's Alex. He's a day trader who's constantly glued to his screens, trying to catch every little market movement. But in his quest for quick profits, he's missing the bigger picture. He's not taking the time to analyze the market trends or to develop a long-term strategy. So what do John, Maria, and Alex have in common? They're all making the same mistakes that 90% of traders make. They're letting their emotions dictate their decisions. They're not diversifying their portfolios. And they're too focused on the short term, missing out on long-term growth opportunities. But here's the good news. These mistakes are all avoidable. With a little discipline, some patience, and a well-thought-out strategy, any trader can turn things around. First, it's crucial to keep emotions in check. That means not panicking when a stock starts to drop and not getting too excited when it starts to rise. It's about making calculated decisions based on facts, not feelings. Second, diversification is key. By spreading investments across different sectors and asset classes, traders can protect themselves against volatility in any one area. And finally, it's essential to think long-term. Yes, day trading can be exciting, and yes, it can sometimes lead to quick profits. But for consistent, sustainable growth, it's all about understanding market trends and developing a long-term investment strategy. So remember the stories of John, Maria, and Alex. They represent the 90% of traders who are not maximizing their profits due to common mistakes. But with a little discipline, diversification, and a long-term outlook, anyone can break free from the crowd and start seeing the returns they deserve. Because trading is not just about making quick bucks, it's about growing wealth over time.